The creed here, so bear with me. She is an assistant professor of practice in the Department of Accounting at Creighton University, where her primary academic focus is U.S. federal income taxation. Who in their college career thought, hey, I want to be in U.S. federal income tax
Not even me. Yeah.
She holds a bachelor's and a master's of accounting from Creighton University and an MS in taxation from Golden Gate University, and has achieved the Charter Advisor in Philanthropy designation from the American College of Financial Services. She is a licensed certified public accountant and spent 21 years in the practice of public accounting prior to entering her current role at Creighton. Her public practice focuses on the taxation of corporate and pass-through business entities and high net worth individuals, along with tax consulting and compliance for nonprofit entities. She also led the federal tax controversy practice at her previous firm. Her current research interests include federal tax policy, including economic incentives inherent in policy elements, and the effectiveness of those incentives. She speaks regularly on a broad range of taxation topics and has been published in the Tax Advisor, the AICPA's premier professional publication, and serves as a member of that publication's editorial review board. She also serves as a faculty advisor of Creighton's student-led volunteer income tax assistance clinic that provides free income tax preparation services to more than 600 members of the Omaha community annually. Please join me in welcoming Dana.
Thank you so much. Good morning, everyone. Thank you so much for having me. I don't know if you guys have been tuned into the news in the last, it's been a really interesting 24 hours in higher ed. And it's finals week, so naturally when somebody hacks our online learning platforms and we can't access them during finals week, that's a really exciting thing to have happen. So this is a wonderful thing to be spending my time doing today instead of dealing with that. So thank you again for the opportunity to get together. And thank you, Emily, for reaching out and asking me to come and be with you this morning. So what we're going to do today, in all of your roles, I know you're all familiar with the process of soliciting donations from particular donors that sometimes don't come in the form of cash. And lots of times we've got the opportunity to seek out some specific types of donations or gifts from our supporters that have some meat on the bone, right? So that are a little bit more complicated. And so that's what we're going to spend our time this morning, is talking through some of those types of examples, how to identify donors that might be good fits or prospects that are worth talking about in some of those unique situations, and also just kind of some things to be aware of. Maybe not necessarily pitfalls, but just some things to kind of have our eye towards. I'm gonna make sure I'm using the right clicker. This guy, there we go. So here's what we're going to do today. We're going to talk about some specific types of non-cash contributions that are going to commonly encounter with most of our donor group. We're going to talk about kind of some pros and cons, if you will, for each of those kind of main types, what we can be aware of. Some ideal donor profiles, who might be good fits for this particular type of asset contribution, and some things to think about from a compliance standpoint. As an accountant, by nature, I'm always focused on risk. And so what are some of the things we need to be considering? The plus side is getting the value of that asset. The downside might be we've got some additional compliance things we need to be aware of that can add cost or complexity. So just giving us some awareness of those so we can plan accordingly. Sound good? All right. So the types of non-cash assets we're going to talk through today, obviously there's an infinite number, but they tend to kind of settle around these kind of four main categories. These are the ones we tend to see the most frequently. So we're going to spend our time talking about these. First of all, marketable securities. These are definitely probably the cleanest and the easiest in terms of non-cash assets that we can access. And we'll talk about good opportunities to do and why donors are motivated to give us those types of assets. We're also going to talk a little bit about closely held securities. We're very fortunate to live in a community that we have lots of incredibly successful entrepreneurs that have grown businesses from the ground up. And in many cases, as those businesses are changing hands, as we're seeing generational transfers and so on, there's lots of opportunities to unlock some of the value in some of those organizations that have been grown here locally. And in many cases, the equity interests or the securities of those business interests are an opportunity to access value. So we'll talk about some scenarios where that might make some sense. Real estate is another area where we tend to find donors having access to value that they've got locked up in those assets and want to be able to transfer that value to us. But there are lots of things to think about, especially as it relates to real estate transfers that we'll talk about as well. And then lastly, we'll touch on just briefly artwork and other types of collectibles. That's not quite as frequently encountered, and we tend to see that a lot more in what I'm going to call maybe more specialty types of organizations. We see them in, fine arts organizations probably more often, or more kind of specialty types of causes. But again, we just want to be aware of what our options are as it relates to those types of assets. So to start with, marketable securities. Right? Again, this is probably from a non-cash perspective, the most popular, the most common, the easiest for us to deal with. Most of our donors, especially if our donors are of a higher net worth, have access to these types of assets. An incredibly common thing for them to invest their value in. Right? They're highly liquid, right? Very easily transferable. It's not a complicated process or a costly process for a donor to transfer those types of assets to our organizations. It can be as simple, right, as sending an email or making a phone call to that financial advisor or custodian to transfer those assets from one account to another. It's not necessarily a complicated thing to have happen. Why are our donors motivated to transfer those types of assets? Well, as a tax nerd, I can tell you, primarily, right, one of the best things, if you will, from a tax perspective about being able to transfer those types of marketable securities is most of the time we're going to transfer them when they've appreciated, right? And what's our other option to unlock the value in those assets? Well, I have to sell them, and then I have a capital gain, and then I'm going to pay tax on that capital gain, and now I have less money in my pocket to give to the causes that are important to me. So we're very fortunate that we've got some provisions in the tax code that say I can actually transfer those assets directly, and I kind of get the best of both worlds. First of all, I get to give my cause the amount of value that I want to, right, without having that tax drag on it because I don't have to recognize that gain, right? So it's a win for me from a donor perspective because, let me give you an example. Let's say, for example, I have shares of stock. I'm going to pick Apple. Right? I have shares of Apple stock that I paid $10,000 for 5 years ago, and now they're worth $100,000. I'm just making up numbers. So if I wanted to give that $100,000 of value to Children's Hospital, for example, one option would be that I sell those shares and generate $100,000 when I sell those shares on the market. But now I have capital gain of $90,000, that growth that has occurred since I purchased the assets 5 years ago. And if I'm paying capital gains tax at roughly 20%, right, now I have to write a check to the government for $18,000, and I don't have $100,000 to give you anymore. Right? I had to give up some of that value to recognize the tax consequence. The alternative is to give that $100,000 of Apple shares to children, and I don't have to pay any tax on that inherent gain of value that's incurred since I purchased the shares. Again, a best of both worlds. I can transfer the value I want without any tax drag, and the best part, right, my good friends at Children's Hospital are a tax-exempt entity. They're not paying tax on that inherent value increase either. So we both win. I will put a little asterisk there for those of us that are representing private foundations. Private foundations do have an investment tax that they incur, but that investment tax is at 1.39%, right? Compared to the 20% or more that our individual donors might be experiencing. So again, from an overall economics perspective, that's a win. What it does require, though, is some infrastructure, right? We as an organization need to have a marketable securities account that can accept those kinds of assets. And many of us do, right? But if that's something new or we haven't experienced that before, we need to make sure that we at least have that infrastructure in place. Have our own, again, a custodian account or otherwise to accept those assets. Then we have to decide as an organization, do we want to maintain those assets in that form, or do we want to liquidate them and have the cash so we have it to pay for programming? And that's up to us. Right? But in any event, we're going to need to have an account to receive those assets in kind. Yeah, Emily, question.
If you were to receive stocks, I don't know if you can answer this, and keep the investments because we value the gift at the average of the high and the low and the
Yep.
day, would you value the gift the same way?
Exactly.
Okay.
Yep. Yeah, how we report that from a revenue standpoint, if you will, doesn't change. Yeah, that doesn't change at all. But again, that's an organizational decision from that point. What do we actually do with the value of that asset? Is it more meaningful for us to hold on to that Apple stock because we think future growth is worth holding on for? Or do we need the cash to support our mission? Right? And we have the option to do either one. I'm not going to spend a ton of time. We can talk about it certainly from a Q&A perspective, but I'm not going to spend a ton of time on the details of marketable securities because I think most of us have probably encountered those or at least roughly familiar with how that works because it's incredibly common. What's a little less common are closely held securities. And what I'm talking about there are typically, right, family-owned businesses, things that are not traded on a market, right? That are changing hands privately. Most of the time, when we encounter a situation where donors are interested in potentially transferring closely held security, this might be closely held C corporation stock, this might be partnership units, this might be S corporation stock, if that's terminology you're familiar with. But most of the time, when we see those kinds of things transfer, it's because we're anticipating some kind of a liquidity event around that business, most of the time. Because otherwise, those business owners, those entrepreneurs, aren't inclined to, right, give that ownership or give that input into how the business is run or otherwise away. Right? So when we're willing to relinquish the ownership in that particular entity, most of the time, it's because we're anticipating a sale transaction or some kind of other transition. And we simply want to create an opportunity, a tax-effective opportunity to transfer some of that value. Not all that different, at least from a tax perspective, than what we experience when we transfer marketable securities. We've shifted that inherent gain in the value of that equity interest. It's no different than my Apple stock certificate, only it says Rouse Corp on it, right? Practically speaking. Right? The transfer of those types of assets works very similarly. But what happens in those scenarios, again, is typically where somebody has already at least floated the idea to us that we're thinking about selling this business. Or I'm thinking about, sunsetting my involvement with that business. And I'd like to unlock some of that value. Again, just like we experience with marketable securities, that inherent gain in that stock or that partnership interest is not taxable to the donor if we've had a bona fide transfer to a tax-exempt organization before they ultimately sell the organization to some outside third party. So we get that elimination of the capital gain recognition. That's why it's attractive to a donor. Why is it attractive to an organization? Because there's value, but, right, there are some caveats to that value. And those are the things I really want us to dig into a little bit here as we talk about these. First of all, for a donor to claim a deduction for that on their income taxes for the fair value of those shares, because we're allowed to take that deduction at fair market value, we're required to have an appraisal. Right? We refer to it in my world as a valuation, but it's the same thing. Right? It's an appraisal, because we don't have the New York Stock Exchange or the NASDAQ to tell us what those shares are worth. We don't have some independent confirmation of what that value is. It's rather subjective, right? So we need experts to come in and tell us what we think that's worth. That doesn't happen for free, right? There's cost associated with that. Sometimes that process takes a while as well. We had a whole, my background is I was in public accounting before I came back to higher ed, and I was at Lutz here in Omaha for 21 years. And we had a whole department that did nothing but valuing businesses. But again, that's not something that you could call them up on a Monday and by Wednesday afternoon at 5 o'clock, they had that value for you, right? That's a process that takes a lot of analysis, lots of information gathering, and so on. So we have to, first of all, have the appropriate timeline to enable us to get those values. Yes, ma'am.
I'm gonna be all your questions.
I love it. I love it.
How close does the appraisal need to be to the gift date to still be valid?
As close as possible. There's not a black and white statutory rule about that. The rule is I have to have that valuation before I file the return where I take the deduction on it. I don't necessarily have to have that valuation at the time the transfer occurs. Okay. But they would have to have retroactively attributed that value to the time of the transfer. Does that make sense? Right, so for example, again, just to kind of drive that point home, we make this transfer of my closely held S corporation stock on December 15th, and I want to file my tax return by April 15th. I would have to have had the valuation expert come up with that value before April 15th, but they would have had to do all of their analysis based on the value of that organization at December 15th. Does that make sense? Like using contemporaneous information and otherwise. But we do have some time. Yeah, go ahead.
Typically, a business owner gets ready to sell, they'll get an appraiser or a valuation when they're ready to sell. Can you use that same valuation for the IRS purposes, for appraisal purposes?
I would tell you, in my opinion, there's risk with doing that because value is in the eye of the beholder to a certain extent. And depending on how a business was valued for a strategic acquisition, for example, might come up with some different analysis points, if that makes sense. Typically what we would see is a second or a backup, if you will, valuation specifically for the gift is normally what I would tell you.
Clarification, the
Yeah.
appraisal needs to be done by the nonprofit.
No, not necessarily. Not necessarily. It just needs to be someone that's qualifying, right? More often.
And that's being organized by the nonprofit facility?
Again, not necessarily. In fact, I would tell you more often than not, it's the business owner that's making that facilitating that kind of analysis. And to this point, we're doing some of that anyway if we're anticipating a transaction because we want to know what our business is worth when we go sell it to someone. Right? So we're gathering all of that data and necessary information anyway for those purposes. But it's incredibly important if I want to take that deduction at fair market value, the IRS rules say I have to support that with an independent appraisal. And in most cases, I have to attach that appraisal to my tax return when I take the deduction. So I need to have that prepared and contemporaneous. Another thing for us to be aware of is that's probably one of the riskiest areas from an individual income tax perspective for the IRS to come in and ask us questions, right? Because there's so much subjectivity around that. So the better, it's not as simple as, calling my buddy that knows a little bit about this industry, right? And letting him come up with kind of his pie in the sky version. We should anticipate scrutiny. So we need to do the best that we can to make sure that we've got the most appropriate and solid documentation for that analysis by people that are qualified to do it. We also, go ahead.
Is there some sort of rule about when they're thinking about selling the business?
Yes.
And we can't have that pre-negotiated?
Yes, so that's the most important step to this, right? Is I can't already have a sale document or a letter of intent or anything like that already in hand when this transfer happens. I have to really be forward thinking because the IRS has, I just finished teaching my undergrads about this, the concept of the assignment of income doctrine, which says, I'm going to pretend y'all are my undergrads for a second, which basically says income is taxed to the party that earned it or the legal owner of the asset that generated it. Okay. So if I, Dana, have already made arrangements to sell my S corporation stock to an acquirer, I can't simply take 100 of those shares and give them to the University of Nebraska Foundation on the eve of the transaction and have all of that income be attributable to them. Because I already negotiated that transaction before they were ever an owner. Right? I'm not allowed to reassign that income that's truly mine to a different taxpayer. So if I'm anticipating a transaction like this, it's incredibly important that I'm thinking strategically about this kind of a transfer well before I sign any of those documents, right? Because of that assignment of income doctrine concept. So if I'm anticipating the best time for me to be having these conversations with my donors is before they've ever even started to think about selling their ownership. Planting that seed as soon as possible. You know, hey, are you aware this is something that you could do? And as we get down the road or as we're thinking about, again, whether that's transition planning, whether that's outright sales or otherwise, now would be a good time for us to have some conversations about what that might look like. As you're starting to approach that market for the business, we should really start thinking about affecting some of these transfers if this is something that you want to do. Though we'd have to be incredibly careful about trying to do that on the eve of a transaction, because the likelihood is very high that that would be recharacterized and we wouldn't achieve the donor's goal of having that income not be taxed to them, having that value go straight to the charity. Does that make sense? So the thing I want you to take away from considering transfers of closely held securities for probably the most important thing is this is the longest runway. Right? This is not something we can do on the eve of a sale or other transfer. Right? We need to have those transfers in place before we ultimately sell those assets. To be aware of that. Yes, ma'am?
Does it make sense if the donor is only mildly interested in the philanthropic aspect of the gift, but more interested in the tax cut of it?
Yes. 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 Now, what I would tell you, my experience in practice is that people don't just give stuff away to give it away, right? Like they have a reason, they have a motivation, they have a cause they want to support. And the more tax effective we can do that, the better. But I'm not just going to give you $100 if I don't believe in what I'll keep the $100. Does that make sense? You know, so I mean, if I've got motivation to support the cause, I want to be able to do that in a way that costs me the least amount of tax, right? And allows me to give as much value as possible that I'm comfortable with or is appropriate as far as I'm concerned. Right? But I'm not going to just give it away because, again, this is something that I say to my undergrads, right? Until the tax rate is 100%, I'm better off making money because I'll still have something left over after I've paid the tax. So we just want to make sure we're always kind of keeping those general concepts in mind. Some other practical things to think about here. Many times in closely held organizations, the governance documents, right, that help us determine what we can do with those partnership units or with those shares of stock have restrictions in them. Right? And we need to make sure that we're not trying to effectuate transfers that aren't allowed by the governance documents for those ownership interests. That doesn't mean those couldn't be modified if that's everyone's goal, right? But we have to be sure that we're aware of what those documents say. Do such transfers, for example, require their corporate board to approve them? If so, then we need to go through all the right steps to get that approval. Are there restrictions on how much or how many shares can be transferred in a particular period of time? Are there restrictions on how close to a transaction shares can be transferred, so on and so forth? So we definitely need to make sure we've got legal counsel involved in all of that analysis as we're trying to look at these types of potential transactions. If we, the tax exempt organization, hold on to these securities for a period of time, and usually there's at least some period of time, because I just told you don't do it on 11:59 on the 30th and we sell it on the 31st. There's going to be some period of time that we actually own those shares. And frequently these will be pass-through types of entities for income tax purposes. That's going to create some additional tax reporting obligations for the tax exempt entity. And more often than not, those tax obligations are going to include those 4 scary letters, UBIT. More often than not, right? These are operating businesses that are operating trades or business. And we know as tax exempt organizations, if we're participating in those types of activities, there's a corporate level tax that applies to us. We don't get out of that simply because a donor donated their partnership interest to us, or because they donated their S corporation stock to us. We still have those obligations on any of that income that passes through to us as a result of our ownership. So we need to, first of all, be prepared for the additional just administrative requirements. We might not have ever had to file a 990T before, but now we have to, right? That creates some administrative responsibilities. That creates some admin cost, right? That might require estimated tax payments that we haven't ever had to make before, so on and so forth. So it's not as cut and dried, right, as just receiving, again, shares of Apple stock. There's a lot more that potentially that's part of it. And most importantly, as it relates to those UBIT consequences, you guys probably already know this, but the vast majority of small business is owned and taxed as an S corporation. The vast majority of it, that's how it's organized, which is basically a hybrid, treated like a corporation for legal purposes and like a partnership for tax purposes. I'm way oversimplifying, but that gets the point across. So when that happens, that income's getting passed through to the tax exempt entity just like every other shareholder. And we're going to be subject to reporting requirements and potentially that corporate level tax on whatever our proportionate share of those earnings from that business activity are. That changes the flavor of the gift a little bit, doesn't it? I mean, so when we're thinking about what are we getting as an organization out of that gift, it's not as simple as the value, especially if we're going to hold on to it for a while. Right? We're going to have these additional administrative costs. We're going to have this additional potential corporate level tax to pay. That changes the tenor of the gift a little bit. So we just want to make sure we're going into that with our eyes open. If I sell S corporation stock, the capital gain the organization, the tax exempt organization, experiences when they sell the stock is UBIT. Yuck. So that makes it a little less attractive, right, compared to, again, a marketable security, because tax exempt organizations don't experience capital gain on those types of assets. They don't pay an entity level tax. We will on S Corp stock. Okay? So it's important that we understand those implications as well when we're trying to determine what is the organization truly going to realize out of this gift. There's more drag on it, if you will, from a tax perspective than we would otherwise experience. Yes, ma'am? Yeah.
Is there a percentage that they're taxed, that UBIT is taxed? I mean, like,
It's corporate level tax. So right now the corporate level federal tax is 21%, a flat 21%. And then depending on what state you're in, Nebraska for most of us, will have the Nebraska corporate tax, which is between 7 and 8% as well. So if it's meaningful, it's real money in terms of how much bite those tax consequences will take out of that value. Again, does it mean we're going to forgo these kinds of gifts? Not necessarily, but we need to understand truly what are we getting when we're analyzing those. Yeah?
Is it possible to do part gift, part sale with wholesale
making their whole business without having a prearranged sale?
Say that to me again.
Okay, if they want to donate a share of their business,
Mhm.
of their business, but they're liquidating their whole business.
Yep.
And they know who they want to sell it to, can you do a part gift card sale without it being a prearranged sale?
If we have, I might know a party that I'm interested in, but I would tell you, my rule of thumb would be, once we have a letter of intent with that third party, we've probably missed the boat.
And so with that, anticipating scrutiny, if they were planning to sell their shares that they weren't donating to a person and they had a letter of intent on both sides, would that put us at
Yes, yes. Because effectively what's going to happen, I'm not going to have a buyer that's going to come in and say, I only want to buy the 80% you still have, and I'm totally fine with letting the foundation own the other. That's just not practically going to happen more often than not, right? So what's going to happen is we're going to sell the whole thing, right, to this buyer, and my donor's going to get 80% because that's what they still own, and the organization's going to get the other 20 of the sale proceeds, right? So that we're probably not going to, not to say it couldn't happen, but practically speaking, we're not likely to run into scenarios where a buyer is going to be super pumped about ongoing shared ownership with a tax exempt organization.
Yep.
Not likely. Okay. Doesn't mean never. I haven't seen it. Okay. Oh, sorry. I've been clicking this whole time. Why didn't y'all tell me? When we talk about real estate, we're going to talk about encumbered real estate with debt on it. So but before we get there, I want to say one quick thing while we're talking about UBIT in the context of closely held entities. We also see closely held entities organized as partnerships and taxed as partnerships. And normally speaking, simply having ownership in a partnership that has pass-through income doesn't necessarily give rise to UBIT income for tax-exempt entities. The operating income of the business that gets passed through, yes, when I sell the partnership interest, not typically, with one exception. If the organization, or if that partnership has debt. So I don't know if you guys are familiar with another potential provision of UBIT happens when I have income that's generated by debt-financed property. Okay. And the thinking behind that, right, is nonprofit organizations shouldn't get a competitive advantage to go out and leverage a bunch of income-generating property and not pay tax on that income stream, while every other, taxable entity doesn't get that advantage. That's the thinking behind that. I shouldn't be able to go out and use the bank's money or other creditors' money to generate a tax-free income stream. That's the logic, right? More time and energy than we have to expend here this morning, but right, partnership tax says when I sell my interest in a partnership, what I'm really doing is selling my proportionate interest in all of the partnership's underlying assets and liabilities. That's what partnership tax says. So if I, as a tax-exempt organization, sell my partnership interest, and we've got assets that have debt on them that are generating income, part of my gain on the sale of the partnership interest is probably UBIT now too. All of this to say, this is the most complicated non-cash asset I can get. Given our environment and given our community and how many successful business owners we have in our community that are incredibly philanthropically minded, we are so blessed to live here, truly. I mean, from that perspective, this is the most complicated gift we can have. But I'm remiss if I don't tell you about it, because there's so much value in our community locked up in these types of assets. Okay? And we have donors that want to give them, but they take time, energy, legwork. Yes, ma'am.
I just want to say, if your organization is not equipped to do so, community foundations can, and Todd knows all about it.
Yes, absolutely. Absolutely. I cannot encourage you strongly enough to make sure that you have the appropriate professional advisors to help you navigate the administrative and legal and risk complications of these types of gifts. Tons of value there. Right? And we are at a time when we are starting to see an enormous cliff of closely held businesses change hands. This is going to be an enormous issue for you in the next 20 years. Yeah, go.
Can I ask another, maybe,
Of course. No, I love it. Come on.
from a beginner standpoint? So let's say we don't have that knowledge.
Yep.
And we're just a regular old fundraiser
Yep.
going in. What are things we should listen for, and what are things we can say that then before we would want to be bringing in somebody else to learn this information from?
Great question. The things that I would tell you are the most important. Like, you know where your donors' money comes from, right? Like, you most of the time, you know where their value is or where their wealth is locked up. Or if they've you know if they're entrepreneurs. Right? In my mind, some of the most important things are, what are your thoughts about, or what thoughts have you guys given to transition planning? What's the succession plan for this business? You know, is the expectation that kids and grandkids, and there's going to be generational transfer? Sometimes that doesn't always work out as well as they'd like either, right? But is that the plan? Or is the thinking, you know what, I know my kids and grandkids aren't interested in owning this business. We're going to be looking for an outside buyer. Great, help me understand how the business is owned, because there might be some really interesting and tax efficient ways for us to help you unlock some of that value to the causes that are important for you. But that takes some legwork, and the sooner we start talking about it, the better. How they own that interest is utmost importance. Right? And at that point, if you hear the words S corp or partnership, get your legal friends, get your tax friends to come into that meeting next time, because it's absolutely a ton of value there, but it's just more complicated. Okay. And again, we probably spent more time on this one than any of the others, but like I said, there's more value here than you've ever dreamed. And this is a huge issue as we are seeing transitions of businesses in the next couple of decades, particularly. Okay. Lots of opportunity here. But UBIT, risk, valuation. Okay. We got to have a long timeline here. Real estate. Just like we talked about with those securities, marketable or otherwise, to the extent that I transfer that asset to a tax-exempt entity that's appreciated, right, worth more today than it was when I bought it, I am not required to recognize that capital gain. And I get that deduction generally at fair market value. So from a donor's perspective, it makes all the sense in the world. Also, I don't have to come up with cash to give you that value. What you may not know is that if this is real estate that has been depreciable for that donor, whether that's a rental property, right, or that's some piece of commercial real estate that they've been using in their trade or business or otherwise, there's a higher rate of tax that applies to that type of asset. So instead of the 20% capital gains rate that I mentioned to you, if I have depreciable real estate, that gain's actually taxed at 25%. So being able to donate this type of asset and not recognize the gain associated with it is even better in terms of tax saving opportunities. Said another way, right? If I have a donor that has $500,000 of Amazon stock to give me with the same amount of appreciation in it as a $500,000 commercial building that they've been renting out, all other things being equal, it's more tax efficient for them to give me the building because they're saving 25% instead of 20%. Does that make sense? So, yeah, go ahead.
So if it's a depreciable asset,
Yes.
doesn't the basis drop down to zero if it's fully paid off?
Not necessarily. Say that to me again.
So if someone paid $500,000 for a commercial
When the
building-
donation happens.
No, that's their cost, $500,000 depreciated.
Other than the
over
land
20
piece,
years.
yes.
They sell it in 22 years, so it's fully depreciated. Is the value then, the cost base is zero because it's fully depreciated, or is it still $500,000?
Value is fair market value.
No, not the selling price, the cost. You gotta pay,
Agreed. Yeah. So when I was doing those two comparisons, I was assuming the same amount of difference between cost basis and fair market value.
okay.
If we're, let's connect after if I'm not answering your question.
Okay, so just, I think, so what you told me is that if the building is fully depreciated.
My cost basis is zero now.
So the capital gains would be higher and you're also paying 25%.
Correct. Yes, exactly. Yes, exactly. And not to get too much into the weeds there, but I was getting ordinary tax deductions for that depreciation the whole time. That's why that 25% rate applies. Congress has said, we're going to make you split the difference. You don't get to recover that all back as capital gain when you got ordinary deductions the whole time you were depreciating. Does that make sense? So again, if I have those two comparative situations, that might be a great opportunity for me to advise my client, hey, this is actually better for you to give a, but then I got to think about what does that mean for us? Right? First of all, what are we going to do with that real estate? Is that something we need operationally or as part of our mission? Are we trying to expand our footprint or provide additional programming and we need more ground to be able to do that? Or are we ultimately just going to turn around and sell it and turn it into cash because we need that cash for our programming? Again, those things take time, energy, effort, right? Risk management. If I'm going to hold that real estate for any period of time, right, there are probably some carrying costs associated. I'm going to have it insured, I hope, right, for at least that period of time. I may be paying utilities, I may be paying property taxes, I may be paying other maintenance costs. Even in that and I may have the best of intentions to be able to sell it, but any number of things could happen in a real estate transaction. My expectation might be, we plan to liquidate this thing in the next 6 months, but the bottom falls out of that particular sector of the real estate market, and then what? So we just want to make sure that we go into real estate transactions with our eyes open as well. We want to make sure we understand what's going on with title, right? We can have lots of complications around titling of the real estate. How do we as the organization want that real estate titled? Again, I'm an accountant. I'm naturally risk averse. Would we prefer to have that piece of real estate, especially if we're going to hold it, titled to, for example, a single member limited liability company entity, as opposed to directly to the charitable organization, to insulate the charity from risk issues associated with that real estate? But we need to figure that out before we title a real estate. So there's lots of things we would want to think about if we're anticipating those types of transfers. What kind of environmental risks are associated? Was there a dry cleaners on this property? Right? Was there a gas station?
Is there a grave?
Is there a what?
A grave?
Is criminy? Yes. Right. That sounds like a battle scar. Is what that sounds like. We've encountered that before. That's a very specific hypothetical example. But absolutely, right? There are risks associated with that. So a best case scenario, right, is this is a piece of raw ground that has had nothing but prairie grass growing on it forever. Right? That's the best case scenario. That's probably not the type of asset that our donor has to give us. So we just want to make sure we're doing our diligence, right, and understanding what risks we're willing to absorb. And then also we have this debt encumbered component that we want to think about. And there are implications for the donor and there are implications for us as the charitable organization. For the donor, if I donate real estate, for example, that has debt associated with it, there's a mortgage on it, right? If I donate that property and I haven't paid the mortgage off, I transfer it subject to that mortgage, the tax rules say you did 2 transactions there, donor. You partially donated your asset, but you also partially sold it because you walked away from your debt responsibility. Somebody else was willing to absorb that for you. So if I'm transferring real estate that has debt associated with that, I will have some gain recognition. That's not a tax-free transaction. But we need to make sure we understand that before we start putting pencil to paper for those types of transactions, because there will be some tax consequence of that for the donor. And like we just said a little bit ago, that debt encumbered property can generate UBIT for the tax exempt organization. If it's generating a rental stream, for example. Right? We might end up with UBIT reporting consequences that we never had before, or even if we are already reporting UBIT and filing 990Ts, we just might have additional tax consequence. And that just changes the flavor of the gift. Right? So when we're trying to determine what's the value of that gift to the organization long term, we just need to make sure we're considering what those tax consequences are as well. Right? Again, like I said, real estate contributions work best when the property is unencumbered, no debt, right? No environmental concerns, and most often, either it's something we can immediately incorporate into our own mission and programming, or we've got a plan to liquidate it right away. Because the longer we hold it, just the more expensive it is. And we just have to be able to try and match our expectations for future appreciation with those costs, net of tax. Artwork and other collectibles. We don't see this nearly as frequently as the other three, but it's probably the one that has the most potential tax benefit, if you will, because collectible assets, we say capital gains and we think that simplifies things, not necessarily. There's a question on my final on Monday about how many actual tax rates might apply to a capital gain. There's 5 potentially. Right? This is the highest one. Collectible assets are subject to a 28% capital gains rate. So in terms of, again, all other things being equal, the same amount of inherent gain in different assets, right? This would be the most tax efficient one to give for a donor because they'll save 28% tax versus, 25 or 20 or whatever their normal long-term capital gain rate is. But just like we experienced with real estate, just like we experienced with closely held securities, obviously there's an appraisal requirement here. And this can be the most complicated one because the tax rules, right, the statutes say or have some requirements around who is a qualified appraiser. And the more specialty, the more niche, type of asset that we're talking about, the harder it can be to find somebody that is qualified to appraise and assign a value to those assets. Right? If it's a very special type of coin, if it's a baseball card collection, if it's an antique vehicle, so on and so forth. Right? It can just be a little bit more complicated and supply and demand, right, more expensive to pay for that type of expertise to attribute a value to those types of assets. So just being aware of that requirement and that expectation, again, can help us manage what our expectations are with regard to what we ultimately will have left over from that gift. Yeah.
Are there any qualified appraisers in the Omaha-Lincoln metro area that could cover the artwork and other collectibles?
I'm trying to think of the last time I had one of these, and it was a piece of art. And I feel like, and this has been a minute, so I got to stretch back a little bit, but I feel like we might have used like the curator at the Joslin, or something was able to, for this particular piece of art, happened to be an artist that they were, a kind of a renowned expert around. And it was like a vase. Like it wasn't a painting or anything like that, but it was a piece of sculpture. But to your point, that's hard to find in our community, and it totally dependent on the type of asset. So again, it's not like the IRS publishes a list and says, okay, if you're transferring baseball cards, here's who you call. So there's always going to be risk inherent in that, but we have to do the best we can to try and get and vet their credentials and so on.
Is there any way that what would trigger you need to have an appraisal, as an example?
If I want to take a deduction of $5,000 or more,
But that's on the donor, right?
correct.
Correct, because I was we have an auction every year, we just had our huge gala, we had baseball collections, or a signed Nebraska
Yep.
basketball, things like that. We don't assign the value in the tax receipt, we usually say this is an in-kind donation, and then it's up to the donor to
exactly.
To be able to be assigned value. We describe it and we say this is linked time donation, but, I mean, we do our best to give the tax benefit to the buyer.
Right.
You know,
Right.
it's the item.
Right. Here, there's
The
one,
donor has to assign the value.
put a pin in this, there's one caveat to that we're going to talk about in another slide. But generally speaking, attributing that value is the donor's problem because they're claiming the deduction, right? They're the one that wants the tax benefit, so it's their responsibility.
Benefit to the buyer.
Correct.
So like the basketball as an example, it's like, well, really the basketball's the cost of the basketball.
Right,
For the
it's whatever you paid for it.
Yeah, exactly.
Fair market value is what somebody was willing to pay for it,
Yeah.
right? Where the challenge occurs is when nobody paid for it, right? I just gave it to you. And again, to your point, that's the donor's issue to establish and be able to support that value because they're the one that wants the tax benefit for it. Again, we'll put a pin. We're going to come back to one scenario where, I take that back, two scenarios, where the tax exempt organization is going to have an obligation. Okay. Again, oh, sorry, go ahead.
Okay, so, let's say we have the art museum.
Mhm.
That, was established with a gift of 512, to be exact, pieces of art.
Yep. Hypothetically.
I mean,
Yeah.
hypothetically
Right, right.
valued at $1 million.
Yep.
And the artist is still living, and there's an opportunity for more art pieces. And there's gonna be a conversation about that. I think it's the last bullet point maybe that you're touching on, talking about like a legacy gift with donating those art pieces. And I'm trying to think about like what the best way to frame that conversation would be for a future transfer of additional art pieces.
Great question. So let's get there, okay? Just a couple practical things. Again, most of the time when I'm donating what somebody like me would refer to as a long-term capital gain asset, I get that deduction at fair market value, most of the time. This is one exception to that. If I give this type of an asset, a tangible personal property, not real estate, right, not security type of asset, to a tax-exempt organization and they don't use it in their exempt purpose, they're just going to turn around and sell it. I do not get that deduction at fair market value. I get that deduction at my cost basis, which is probably pretty low. So when I say this type of arrangement works best with legacy assets related to the organization's exempt purpose. So if I'm an art museum, right, and I'm receiving those pieces of art, they're deductible to the donor at fair market value. Your situation is a little bit different because the creator, that's going to be a little different, right? But if I owned a Rembrandt, right, and I decided I wanted to give my Rembrandt to the Humane Society, right, and they're going to turn around and sell it, right, it's deductible to me at what I paid for it, not what it's worth currently today.
What if the Humane Society hung
Hung
it
it
on the
up.
wall and
If they're
the wall
using it
was-
in their exempt purpose, that would be okay. So I skipped a step of assumption there. I apologize. The presumption was they're going to turn around and sell it. But if they're hanging it up on the wall, they're using it in their facilities, then I get that deduction at fair market value. So again, that's another example of that's a very important conversation that has to happen between donor and organization. Not just I'm going to give it to you, but what are you going to do with it? Yeah.
Correct me if I'm wrong, but isn't cryptocurrency and Bitcoin treated more like this? It requires a qualified appraisal.
Right now.
Yep.
Yeah. I think we're going to see some movement in that, really, like more and more, not statute yet, but more and more regulations and guidance are treating crypto more like a stock or currency, but right now it's being treated like coins. Yeah, like a coin collection, if that makes sense. So we've got a lot more complications with that. God bless you if you're getting crypto. There was another question I thought. Emily, did you have a hand up?
Yep, is there a length of time one would have to hang it on a wall? Would it have to be like, we're gonna keep it and use it forever, or could the
Here's my next bullet.
Okay,
Right?
okay.
If I took a deduction at that at fair market value because I thought you told me you were going to use it in your exempt purpose, and you either disposed of it or just stopped using it in your exempt purpose, I likely have to recapture my deduction. Meaning I have to go back and amend my return and take my deduction at my basis, not at fair market value. Because the reason I got that additional tax benefit was because everybody understood this was something that was benefiting the organization's exempt purpose. Right? And if those facts changed within a very specific period of time, 3 years, right, I don't get that same outsized benefit. My benefit's reduced. So we have to have those meaningful conversations when I'm giving this type of asset. I might have a lot of value tied up in my baseball card collection, right? But if I'm donating it to an organization that's just going to turn around and sell it and turn it into cash, I don't get the benefit of that outsized gain. Because it's really not that much different if I just turn around and sold it and gave them the cash. Does that make sense? Yeah, question.
That's an interesting thing to be aware of. Who owns that obligation? That is the organization?
Both.
Because if, like, say, XYZ paintings were received and then all of a sudden that artist passed away and now they're extremely valuable and it makes more sense to sell those.
Yep.
It's,
So the obligation then is the charitable organization, if they dispose of any of these types of assets within 3, so this was my asterisk, right? This is one of them. If they dispose of that asset within 3 years of when they accepted it, they have an obligation to report back to the donor that the use of that asset changed. Because now the donor has a reporting obligation and a change in their tax liability as a result. So all of these types of, I haven't said this yet, I don't care what type of asset we're transferring. We need some kind of written document that explains, here's what I I understand my obligations to be as a donor. Here's what we understand your obligations to be as an organization. Because there are some of these lingering, administrative requirements. Or who's going to be responsible for facilitating the appraisal? Who's going to be responsible for paying for it? Because that may not be the same person, right? We may be willing to arrange it, but ultimately donor's going to write the check or whatever. But the easiest way to get crossways with a donor, right, is to have mismatched expectations. I'm not telling you guys anything you don't already know. Okay? So when we get into these more complicated gift scenarios, we're doing, to be clear is to be kind, right? To have the most well thought out and well documented expectations, then we have something we can go back to, right? And if we don't agree, now we can resolve it as opposed to when the transaction has already occurred, right? And the feelings get a lot harder then. Again, we don't see this type of thing happen all that often, especially we don't really see this happen where donors are giving those types of assets to an organization that isn't in some way affiliated with the nature of that asset. You know what I mean? Like, we tend to give artwork to art galleries, museums, etc., right? We tend to give, sporting equipment otherwise to sports-related organizations. We tend to give taxidermied animals, to the zoo or to, animal welfare organization, whatever. Okay. Where it gets a lot more complicated and more challenging is when we're giving those assets to organizations that aren't going to keep them and use them in their purpose. And I would just say that's just where we need to proceed with caution. We need to make sure we understand what our obligations are on both sides of that and what the consequences are, and document. Because there's the most risk here of that getting recharacterized because of that 3-year look back. So again, our ideal donor profile for any of these are typically our high net worth donors that can afford to part with these assets. Right? They don't need them to sustain their lifestyle or their living. Appreciated assets, right? The most bang for our buck is here because we're saving the capital gain consequences. Right? And if my assets aren't sufficiently appreciated, that's not a major cost. Right? So where this is most attractive is when I have a whole bunch of inherent gain in a particular asset and I'm not crazy about absorbing the tax consequence. And again, frequently those assets are illiquid. If I could turn them into cash as a donor easily, right, I probably would have done so. but I've got a lot of value tied up in them. There's some attractiveness to the donor of making the liquidation of that asset your problem. It is. Right? That can, again, unlock some of that value. That might make a gift of that kind of value. And the better versed you get in it, and the more practice you have at it, the less intimidating that is. Right? And it can get us access to a greater breadth of potential donations if we understand how these work. The ideal donor not only has the ability to, liquid or dispose of those types of assets, the deduction doesn't matter if you can't use it. Right? So we need to make sure our donor has an understanding and an expectation of what their tax obligations are currently and for the very near future. So if you're aware, I have some limitations on how much of my charitable contribution I can deduct each year. For cash contributions right now, I'm limited to 60% of my adjusted gross income. For long-term capital gain property to public charities, it's 30% of my AGI. Long-term capital gain property to private non-operating foundations, it's 20% of my AGI. So if the value of my gift exceeds those thresholds, I'm not allowed to deduct that excess in the current year, but I am allowed to carry it forward 5 years. So it might not be the end of the world if I can't use that whole deduction this year because my AGI is not high enough. But I want to have a very high degree of comfort that I'm going to be able to use it in that 5-year carryover period. I would hate to have the value of that deduction just fall fallow and not get any benefit from it at all. So we want to make sure our donors are aware of and knowledgeable about what their expectations are for taxable income for the next several years to make sure they can use that deduction. Because if they can't, then we might want to look at a different alternative for a gift. Okay. Then a cash gift might make more sense because that limitation's higher. There's just some things to consider. And again, our ideal donor is somebody that's motivated by their philanthropic impact and also the tax efficiency. Because if I'm simply motivated by my philanthropic impact, the value of giving those non-cash contributions and escaping the tax on the capital gain isn't as attractive to me. Right? But most of our donors will be both. Right? They'll have a desire to support whatever our mission is, and they want to give us as much value as they possibly can. And what does that mean? Reducing the tax impact of that gift, because that just means there's more left over to give you. So we want to make sure we're thinking about both of those things. Really briefly, and we don't have the time to dig into this today, but how do we typically see these types of gifts structured? And I just want you to be familiar with these if you're not already. Most of the time, these are direct transfers. Right? They're just transferring title to us outright, most of the time. Right? Sometimes we will see these assets transferred in trust. And typically these are charitable remainder type trusts. Charitable lead trusts aren't very popular, just for lots of reasons, but they tend to be more estate planning focused and less income tax planning focused. But I might have assets that donors want to contribute to those trusts or that kind of a trust structure, just because there's more, again, structure around how that's being facilitated and administered. And that gives some comfort. They're costly and they're complicated. But the larger the size of the gift, the more attractive those structures might be. Charitable gift annuities, these make a little more sense for what I'm going to call smaller donors. They're not typically a great fit for non-cash assets other than marketable securities, simply because they create a cash flow obligation on the charitable organization. Because the donor is giving me something of value in exchange for that future annuity cash flow stream. And I, as the charitable organization, have to be able to facilitate that cash flow, those payments back to them over the annuity period. And if they gave me a piece of real estate, for example, right, I either need access to other cash flow, right, or I need to maintain the cash flow stream that asset is currently generating, or that I expect it to generate to meet those cash obligations. Frequently what happens here, if I do receive a non-cash asset, non-marketable securities, non-cash asset in exchange for a gift annuity, I just go sell it and use the proceeds to purchase a commercial annuity that kind of matches those cash flow streams, if that's not something we have access to liquidity for the organization itself. But I would tell you, in terms of size of gift, we probably see smaller charitable gift annuities compared to some of the others. I in no way mean to minimize this kind of giver, but these are my grandmas, like these are my little old ladies. Truly, because they want the comfort of that expected cash flow stream of the annuity. And they might have some piece of farm ground somewhere, right, that is a confusing asset to own. They don't understand what it's doing for them, or they don't like the obligation of dealing with, the tenant farmer or whatever. That might be a good opportunity. And then frequently we see these gifts made via estate transfer as opposed to inter vivos or lifetime transfers. Obviously, those estate gifts don't do us any good in terms of current income tax consequence. And currently, where we're at in terms of lifetime exemption, a significant number of our donors aren't going to have a taxable estate. So they're not as motivated by the estate tax deduction for the charitable gift. Most of our donors won't have taxable estates. Many will, but most won't. They're more motivated by the income tax donation during their lifetime. So those are conversations we want to have. Again, we've talked over several of these, but just things to be considered about or concerned about when it relates to compliance after the gift has happened or after we're facilitating or while we're facilitating it. Thinking about titling issues. Again, do we want these to be directly titled to the charitable organization? If it's something that's got some risk assigned, like real estate, for example, does it make sense to title it to, again, maybe a single member LLC to insulate the charitable organization and its assets from the risks of that real estate? If I'm concerned that the UBIT consequences of a closely held business interest, for example, are going to start creating either an outsized liability or become too great a portion of my revenues, right? That's a concern for maintaining my tax-exempt status. Does it make sense to have that closely held security be titled to, for example, a taxable subsidiary entity of the tax-exempt entity? So some food for thought there, but these are all things we need to carefully consider depending on the type of asset. Call me, I'll help you. Right? Other carrying costs we might have. Again, is this an asset that we need insurance for? Do we have ongoing maintenance costs relative to it? If it's one of those specialty, personal property type assets, does it need to, be temperature controlled? Does it need to be maintained in a very specific way? Or do we have transportation things we need to be worried about? So just making sure we're aware of those when we factored them into our obligation as part of accepting that gift. 990 reporting requirements. When I receive significant non-cash contributions, I have to include a Schedule M in my 990 filing. So I might have some additional disclosure just relative to receiving those types of gifts. I might, as we talked about, have UBIT implications that now create a corporate level tax consequence if those assets generate an income stream. If I sell one of those tangible personal property types of assets within that 3-year period, right, or I otherwise am disposing of it and not using it in my exempt purpose, I have reporting obligations to the donor and to the IRS. There are even more specialty ones as it relates to when I receive contributions of cars, boats, and airplanes. But even outside of that, other tangible personal property assets, again, like artwork, coin collections, stamp collections, etc. So again, understanding what my reporting obligations are there. And then anytime we're talking about these types of topics, it's a good reminder to revisit our gift acceptance policies. Because we just have touched on the tip of the iceberg of some of the compliance things and obligations that might come out of accepting these types of gifts. And we have to decide as an organization, is the juice worth the squeeze? If we're only going to do this one time, is it worth investing in all of the infrastructure it takes to facilitate this gift? Or are we better off passing on this one? Right? Or trying to come up with alternatives that are a better match for what our organization facilitates. Right? Most often, our donors aren't trying to create hardship for us. Right? They aren't trying to make it difficult. But a lot of times they also don't understand, right, the level of obligation it can create for the organization and when we do these kind of more nuanced types of giving. And it's important for us to be upfront and open about what those obligations are. And frequently our donor will say, that's going to cost X, fine. We'll make a gift to cover that additional obligation. Right? Or we might otherwise, mix up or change up the way we've decided to structure this one to alleviate some of that obligation. Or indemnify you against it or whatever. Okay? But those are not things that we can address if we don't consider them and discuss them. Yeah?
This isn't my own trauma, but I know that when we've accepted gifts of like a collection of pottery, we've requested a gift to cover the storage, the shelving, the maintenance as well. The cash gifts go.
It's a great example, right? Because without that, now we're costing the foundation several $1,000s a year just to maintain the integrity of that gift. Right? And truthfully, many they just don't think about it. Right? And so it's on us. Our responsibility, our organization, is to talk about those and make sure we've got provision made for them one way or another. This is just kind of a little matrix of these 4 types of gifts that we've talked about, who the ideal donors kind of are, and the types of assets that they hold. Who might this fit with? I love this last on real estate. The ideal donor is a tired landlord. They're not wrong. Right? Lots of times, especially as we have as donors that are approaching retirement or thereafter, I have any landlords in the room? I'm one. I'm tired. Just the challenges of dealing with every little thing can get old, right? And if you catch that donor on a day when their tenant has called them and the garbage disposal's broken again, that might be the perfect time to make that ask. But again, this kind of gives us an idea of, as we're looking through our donors or as we're talking with our donors, to identify some potential opportunities of who we might start to instigate these types of conversations with. How do the benefits work from an income tax perspective? So I've talked about those. And then in terms of complexity of planning, if I was ordering these, obviously marketable securities are the easiest. They're the easiest to transfer. I don't have most of those attendant reporting risks and so on. They're pretty cut and dried. But as we approach these other types of assets, the more complicated those can get. So we just want to make sure we have the right team of experts around us to help us, whether those are internally or externally, right? And that we document all of those conversations that we've had and our understanding with our donors and our internal team, just to manage those appropriate expectations. Here is my contact information. Email's still working. Our electronic blackboard isn't working, but my email still works. You can always reach out with any questions. I'm always happy to help answer any questions in this regard or in this environment as you encounter these types of gifts. Any questions? If some come to you later, or you get back to your organizations and you encounter something specific or have a conversation and something pops up, please don't hesitate to reach out. I'm always happy to help wherever I can. Thank you.
All right. Thank you, Dana. We appreciate you coming here and sharing your expertise with us.
bet.
It's nice to know that we have resources in our community that have that expertise. So we appreciate you sharing with us this morning. Our next program is going to be Friday, June 5th at our friends at Lincoln Community Foundation will host that. We will have Michael Geist speaking. If you're not familiar with Mike, he's been in our community for quite some time. He's got 2 books out, I think one of which is called Further Faster. He's talking about moves management and transformative gifts. And his topic is going to be when major gifts and legacy giving become one conversation. So keep an eye out for that. We'll have communications coming out on that soon, and hope to see you guys next month. And thank you for joining us this morning. And thank you again, Dana.
Thank you.